Hey everyone, this is Josefa from BITFX and this is our first ever YouTube video. So in this video we'll be breaking down EURUSD 1:30 RR trade which we got last week. So make sure to stick through the end, like, subscribe and comment down below what you guys would like to see the next. Right on to the charts. So coming on to the trading view chart, as we can see we are on EURUSD daily time frame. And as we can see, the December month has just passed and it was a choppy market. So even though it was choppy market, one thing which we could see was EURUSD was still trying to stay in a bullish momentum. Now how can we identify that? We have seen the market was choppy, but it's consistently made higher highs and higher lows. So market kept on making higher highs and higher lows, or we can say lower highs. So right at this point market had made a higher high, and we know that okay, daily time frame is bullish, and now we are expecting a market to retrace below the 50%. So let's take our Fibonacci and check the 50%. So this will be our low of the range and this will be the high of the range. The 50%, if you guys can see, is right here. Let me just flip this thing. These labels on the right. All right. So now we are at the 50% of this range, and I'll be marking it with the horizontal line. So now 50% of the range is marked, and we can see we came below the 50% mark. So now let's go to the 1 hour time frame and let's check. So one of the main things in this trade was looking for liquidity. So what do I mean by liquidity? I'll just go a bit back and explain myself more clearly about liquidity. Okay. So liquidity in the market is really important aspect of the market. If you cannot find the liquidity, for surely you are the liquidity. So finding the liquidity is really crucial, and knowing where the retail traders are going to get stopped out is the most crucial aspect of your trades. So right here we can see some sort of liquidity hunt which was made for weak retail traders. So this was like a smaller trend line on 1 hour time frame which held on pretty good, and then market came and swept this off right here. So all of this liquidity was cleared. Now what we are looking to do is we are looking to buy, and we need a clearer point of interest. This is a pretty good point of interest. We could have got smaller buys right here as well on lower time frame, but we're not going to go in depth for that. What we are looking at is our EU buys from right this point. So now where comes the liquidity aspect of this? In my eyes was this area of support. So if we can mark this area right here, so this area of support is a really strong zone for the retail community. Now why do I say that? Because we can see the market came, retested, jumped off, came, breakthrough, came back, retested, broke through, and so on. Came back, retested the same zone, jumped up, came back, retested the same zone and jumped up. So what's happening right here is people, the retail community is buying right here. That's what's happening. So all the retail traders have their buy orders right here. So they're in the buys, and their stop losses is exactly below this range. The stop loss is exactly below this range. So there is liquidity in the market. Their stop losses is the liquidity in the market. So our first step was identifying the liquidity in the market. The liquidity has been identified, which is this support area, or you can say the demand zone for the retail community. Let me just refresh this and so we can have a smoother trading view. Okay, so I'll go back in the replay mode and let's go right here. So now we have seen that okay, this liquidity has been created. Now we wait for the liquidity to be swept out. So let's display this, and right here. So right here, market swept their stop losses. So now as soon as the stop losses were being swept, what we were to do was we were to look for a accumulation of orders. So what do I mean by accumulation of orders? So now the bank, as soon as they sweep out their liquidity, the buyers will turn into sellers. So some people will get stopped out, some will panic sell. They'll be like, oh, market is making lower lows, it broke the structure. Let's sell, let's sell, let's sell. If all of the retail community is selling the market, then who is actually buying the market? The banks are buying the market. So what banks are doing exactly into this area, let me just mark this area for you, is this piece of price action is also known as accumulation. So what's actually happening in this area? The banks are closing in their selling orders. So the selling orders which they had from top right at this point, they're closing those orders and they are setting their buying orders right here. So if all of the sudden they closed all of their sell orders, what was going to happen was market was going to just shoot all of the sudden, and even the banks wouldn't get the opportunity to get into the trade. So what they are doing is they're selling some of their orders and then they're buying back some of the orders. They're selling and then buying. They're selling and then they're buying. So they're actually not selling the orders. What they're doing is they're closing their sell orders or their short positions. They're closing the short positions and then they're entering the buying positions. So this is a slow process which they do. So this is what is called accumulation, and the banks are accumulating the orders right here. So we had multiple confirmations. Daily time frame, we had seen that okay, the market was bullish. We had seen hourly that the structures have been shift, the liquidity has been swept. Now coming to 5-minute time frame. Now why did we and where did we enter this trade? Now we can see we are at a strong POI, and what is our POI? This order block at this area. So now I'll just shorten this. So the liquidity zone, just make it a little bit lower, and this becomes our POI which the market actually touched. So right here was the order block which the orders were exchanged. Market came, swept this liquidity out. So the retail traders were out of this market, out of the buy game. Now comes the bank plays. Market taps into our area of interest, and let's see what they do. Now as we can see, what's happening right here are market is making lower lows and lower lows. So what does that mean? Lower lows means that the market is trying to trick the retail traders into thinking and selling, shorting their positions. So if the retail traders are selling, imagine who will be buying on the other side, because for every seller there has to be a buyer. So if the retail traders are selling, so what they are seeing is they're only seeing this part of the price action at that given time. So what they will be seeing is they will be seeing this trend line going on, or maybe this trend line going on. So they will be seeing some sort of a trend going on in the selling direction. So what they will be doing, they will be having their stop losses here, they'll be having their stop losses here, everywhere. They will be having their sells and the stop losses above the structure. They'll be having their sells and stop losses above the structures. So if they're selling these markets, who is buying the markets? The banks. So they're stacking on the orders, so they can be the most profitable of the push, because they want to make the most money, of course. So we don't actually enter at this point. We are not just going to enter based off this POI right here and be like, oh, let's just risk it on this POI only. Let's just not wait for any confirmations. Let's just straight get into this trade without waiting for any confirmation. That's a dumb move. You should never do that, because most of the times even the institutional traders will get trapped, because now the banks are smart. They know what's in the market. They know that the order blocks concepts and these all concepts are out in the market. So how do we avoid them? We set some rules, we set some protocols, and then obviously we wait for the liquidity to be swept and then into the markets. So now there is a different type of liquidity being created. So as you guys can see, everything revolves around the liquidity right here. All right, so everything right here revolves around the liquidity. So now let's fast forward it a bit, and right here, all of these sellers have been swept out. So all of these sellers have been stopped out. So now they're too scared to enter the sells or the buys. So now who is going to come and take the actual buys? It will be the banks. And where do we come into the picture? Let's go into 1 minute time frame and let's assess the chart. So market was making lower lows right here, and then right here it fails to make another lower low. What is it indicating? It indicates that now the sellers pressure has decreased in the market. Now the sellers have become so weak that they were unable to break this. Market comes again, tests the resistance, again creating liquidity, a resistance area for the retail traders, creating resistance, giving some profit to the retail traders, and then stopping them out. So right here, stop these people out, these people out, these people out, these people out. So all of these structures, market structures, consist of stop losses. So all of these stop losses were taken out on this points. So now comes our turn. Where do we actually enter the setup? Now personally, where I took the trade was on this simple 1 minute order block. So my entry was exactly above the wick. So I personally prefer, whenever it's a clean order block, take the entry from the body or from the wick. That's my personal preference, and my stop loss is always below the full structure. So my stop loss won't be below this thing. Why? Because there is nothing non-mitigated here. All the candles have been mitigated on this point. So what hasn't been mitigated is this order block right here. So if the market crosses this, it doesn't make sense for the market makers to actually come down all the way here, because even this red candle has been mitigated by this wick. So everything has been mitigated other than this red candle. So this is the last area of interest where the banks should shoot the market from, and if it goes below this area, that means the trade is invalid. You don't enter the setup, you take the stop loss and you sit back. So you have your entry exactly above this wick, stop loss below this full swing point, and now you wait. So right here we get into the setup, and as you can see, our stops weren't triggered. Why? Because our stops were below the market structure, below this swing point, and it didn't make sense for the markets to come all the way down and test this areas and then launch. It doesn't make sense. Firstly, there is nothing non-mitigated over here. Secondly, this was the impulse point, this was the order block which was responsible for this aggressive of a push to break all of these market structures. So if this high was broken out, this high was broken out, this was broken out, this was, all of these areas were broken out, such strong order block should hold and should be the only option to hold. Because if we were speculating and expecting that okay, this order block might hold or this order block might hold, we can see the strength of the order block. Checking this order block out was, if this order block was to hold, did this order block, if we were to take a trade on this, so if we are seeing the order block, did it actually break any structures? Did it generate a strong enough move? We can clearly see it wasn't strong enough to break any of these major structures. Again, coming back to this candle, was it a strong enough order block to create a strong enough push? Exactly, same answer, no. So the last option is this order block right here, which was a strong order block and which generated a strong push. Right here, market pushed up and then came all the way down into our entry, didn't get stopped out. We had, I think, a 1.6 pip stop loss right here. Let's go back to 30-minute time frame, and yeah, 1.6 pip stop loss. Alright, so now the question comes, where do we take our partials and our profits? So firstly, what we do is we open our Asian session indicator to know where our Asian highs and our lows are. So right here we can see our Asian high is still not taken out, as well as our London high is there. So it's a cherry on top. So now what do I mean by cherry on top and what do I mean by the Asian high? I'll be making a separate video explaining about the Asian session range in depth. But just in short, Asian session highs and lows are like liquidity grab areas for the banks. So let's say this is a bag of money right here. So what we can do is we can find a symbol. We get symbols from right here, and let's say this is a bag of money right here, and this right here is a man standing, and this is a uphill. So the man goes and right here is standing there and he sees his bag right here. So now what he will do is he will go uphill, he will climb, go take the bag, and then potentially look for another bag maybe up higher, or maybe he's too tired and he will come down again and spend his money. Same way for the banks, this is a liquidity zone right here, the Asian highs and the Asian lows. So right here, the Asian high which is not taken out is like a bag of money for the banks. So now banks are sitting here and they're like, okay, now this is a bag of money right here. So imagine you're thinking that, okay, why don't we close our trade right here and why do we hold our trade till at least this point? It's because the banks need to take the bag of money, because imagine coming all the way top of the hill and the bag of money is just right here, and you don't take the bag of money, you just stare at the bag of money and you come down. Does it make sense to any of you? No, right? Because any sensible person, if he sees a bag of money, he will go and he will grab it and then come down. Same way, what banks will do is they will go, they will see this liquidity and they will grab it. Let's see what happens. Market goes and grabs this liquidity. So as soon as this happens, the bag of money is taken, we will take our major profits out. So 70 to the 80% of our partials will be closed, because at this time we don't know the person who took the bag of money, is he greedy enough to go back again up and look for more, or is he tired enough to just come back down, right? So we will not take that chance right here. But we still know, as let's say we are the spectators, and we know that okay, there is more bag of money. This imbalance right here is like a magnet right here. So we say there's a magnet which is attracting that person towards this area. So we will keep that extra 20 to 30% of our positions running, just in case the man tries to go back up. In this case, the bank tries to go back up for the second bag of money. So right here, market comes, tests our area multiple times, and again goes back into this zone, which was our imbalance right here, as well as this was a support resistance zone for the retail community. Market comes, touches that neckline, our TP target has been hit, and this is how we took this trade. And this was the 1:30 RR Euro USD setup. Thank you all for watching. If you guys enjoyed the video, make sure to like, subscribe, and comment down below what you guys would like to see next. Till then, peace.